we have is a financial system that has evolved in ways in which it very largely serves itself rather than the needs of the non-financial economy.
The purpose that they served became all about the profitability to serve their capital, rather than about being able to serve their customers and the needs of the economy.
Our financial sector has been dominated by a small number of players for a very, very long time. It's had a very harmful effect on enterprise.
We've got used to a world where we're quite happy with other people managing our money, and what's happened is those people have perhaps taken too much power over how that money is used and where it is invested.
We are still living through the worst recession stroke depression for 70, 80 years. The cost of this in terms of lost incomes and lost jobs globally are astronomical.
I think that what we're going through is not only a financial crisis, but a crisis of the economic system as a whole, capitalism, if you like.
At the moment, the financial system is driving a potentially huge environmental catastrophe and a huge human catastrophe.
We have to find a way to allow upwards of 9 billion people, predicted, to live comfortably and well and equitably and peaceably on an increasingly crowded planet. We don't have an economic system that is fit for that purpose.
We have today a financial system which has really gone off the rails completely. It's lost its core function, which always was to serve the economy by allocating credit.
So what we've seen in the last 10, 20 years is increasingly within the universal banks that the money is being used for speculative financial transactions to make a profit on, if you like, the movement of money in the real world rather than investing into the real world.
If you look at the balance sheets of British banks and ask what proportion of them is lending to real non-financial businesses, the answer is 3% of the total. What intermediaries are doing now is not serving the needs of customers, they're actually trading with each other.
The real economy has rather faded from their sights. They're speculators, they're market makers, they're wheelers and dealers. And making money out of money doesn't really help anybody.
After the financial crisis, there's now been lots of emphasis on rebalancing the economy. And the assumption there is that, there's been all these problems with the financial sector, and so we actually want to rebalance away from finance towards the real economy. However, this emphasis on finance bad, real economy good, ignores one of the biggest problems, which is how financialized the real economy has actually become.
The preoccupation of managers with share prices has led to a kind of completely dysfunctional short-term earnings management cycle. What businesses are concerned to do is to generate a pattern of quarterly earnings that is a bit ahead of analysts' expectations. Well, I think the consequences, and the consequences that matter of this kind of short-termism, are the consequences for the actual performance of businesses. And what we've seen is a variety of demonstrations of this problem. One very large one is the extent to which companies, and the financial institutions are the worst in this, have undermined their relationship with their customers in pursuit of short-term profits.
The key banks that we have today are incredibly homogenous. I mean, it's four large monsters who essentially provide the same services at the same price to the same group of people. And we just can't go on sustainably with that kind of setup.
What we've seen over the course of the last 100 years is the bigger banks getting bigger still. And that's because the bigger the bank, the greater the chance that the government will need to ride to their rescue. And that in turn lowers their costs of funding and makes them more profitable, which means that the biggest banks get bigger over time. This is a natural, it's an evolutionary cycle, what I've called elsewhere the doom loop. The large become larger still. Their failure would impose even larger losses on wider society, which is why government would feel ever more duty-bound to ride to the rescue, which increases the implicit subsidy and fuels another round of this doom loop. It's been operating for generations.
One of the flaws with the existing banking system is that large banks enjoy an inherent advantage, the so-called too big to fail subsidy.
The costs of the too big to fail problem come in various types. So one obvious cost is that having put all your eggs in a single basket or a small number of baskets, when failure comes, when problems strike, the government feels obliged to ride to the rescue, and that comes at a cost to the taxpayer. But as important a component is the ongoing cost of a failure to innovate within the financial system.
One of the things that has happened as a result of the financial conglomerates which have developed over the last 25 years is that we created entities in which the trading culture was allowed to permeate the whole of the institution.
I do think this is a societal problem, not just a city problem. It may just be that because it's in the city, it's got pounds, shillings and pence attached to it, so we've been able to count the cost. But society is in difficulties in all sorts of ways, and perhaps just the city happens to be the last part that's been gone wrong and that we've noticed.
There are some really big systemic problems within the investment industry. That's not to say that individuals are trying to do the wrong thing. It's just that the way the system is designed, it's a bit like a perfect Swiss watch designed to tell the wrong time.
I think it's a mistake to see the city as full of evil people doing bad things, deliberately making poor choices when they know they should be doing something else. It simply isn't like that. But I wouldn't underestimate the power of the system to make people believe that what they're doing is a good outcome, when often that is not the case. And that's why I think these kind of structural issues need to be addressed.
Personal responsibility is enormously important. It's very easy, as we saw in the financial crisis, we heard time and again how it wasn't individual financiers' fault that the crisis had occurred, it was the system's fault. And yet, you can't simply blame the system. You each have personal responsibility to make the system what it is and to act out according to our values and ethics.
Cultural changes are things that can only take place over a longish period of time. But having said that, we shouldn't be sceptical about our ability to do it. The changes which have occurred over the last 30 years, many of which are for the worse, have come as a result of changes in culture, ideological, intellectual shifts. If you can shift them in one direction, you can shift them in another.
We can do things to try and force banks to improve their culture, and that would be good. But all of those, I think, are changes that government can't ensure. So they can't ensure their effectiveness. What we can do is make sure there are many more players in this market, and that is the kind of disinfectant. That is the approach, I think, that can keep it healthy.
So one of the greatest intellectual mistakes, actually, that we made in that pre-crisis period is we confused in our minds two quite different concepts. The concept of diversification, spreading risk across a portfolio, and the notion of diversity, meaning having different types of businesses in the marketplace.
If we want a really resilient financial system, it's got to be a diverse financial system. So not just more banks, but different types of financing entities, arrangements, organisations that build resilience into the system that would respond to shocks differently.
I mean, arguably, we only have one business model at the moment, which is a bank, and that's dominating the sector, rather like the dinosaurs. And what we need are nimble, agile, innovative, new business models that can provide proper competition to banks.
We need new players with a different approach, new players who think small business is an attractive customer, new players who look at innovation, both technical innovation and innovation in the kinds of services that they offer. And so we have to enable that.
So for governments considering reform right now, I think it could be quite easy because the business models are already there and they're already proving to be successful. And once the clamour of the decision-making on these big urgent issues on governments falling over and banks falling over subsides a little bit, I think that policymakers will be able to see that it is a case of being able to look at these examples of successful sustainable banks and other financial institutions and just nudge the system to accelerate that development. I think values-based banking is banking which is really meaningful to society in the real world. So it has a different starting point to those who are in the business for profit in this financial system. So the unwritten rules of the organization are not driven by profit, they're driven by wanting to do something positive in the world. Profit is seen as a way of being able to then support that. This isn't just about being nice again as banks. This is dealing with the world's challenges. We have huge environmental problems, huge social inequity. There's things which we need as society to be built. And unless there is a banking system which in itself is healthy in creating these connections to build the new institutions which serve our purposes, then we'll be on the wrong path. And I think that sustainable banks in working with entrepreneurs can actually be leaders themselves. If the financial system isn't reformed by governments, then it's going to be reformed by people anyway.
The values of society and the values of the financial system have been completely disconnected. They're completely out of alignment. But if you want to realign them, it's easier actually just to say, I'll move my money, I'll take my money somewhere else and put it where I believe it's doing some good, whether that's a financial return or a financial return with an ethical or sustainable value as well. And that is the only way you will change the system. So the direct finance platforms, SOPA, Abundance, Crowdcube, these types, they give you some element of control because you decide exactly where your money goes and how it is used. No one else makes the decision for you.
Peer-to-peer finance is more efficient than conventional banking. So by connecting our consumers directly, we can pass that efficiency back on to consumers. In our case, in Zopa's case, there's also an advantage in that we don't transform maturity. So our lenders and our borrowers agree to lend and borrow over the same time period, which creates a great deal of stability. Well, peer-to-peer finance has grown significantly. This year, for example, volumes as a sector are 300-400% up on last year, at a time when bank lending is contracting.
The main limit on growth is one that's starting to be addressed, which is the regulatory framework and the way that it deals with alternative finance, crowdfunding or peer-to-peer finance.
When we first started calling for regulation, the government was concerned about it was because it could be deemed to be raising a barrier to entry, for example, so making it more difficult for new businesses to launch. Our argument's always been the reverse, in fact. We want to work in the consumer's best interest, so the regulation doesn't need to be very heavy-handed, but just needs to make sure that consumers are protected at a sort of fundamental level.
Government has to be made to see, if necessary, its responsibility as the architects for social cohesion, for a socially responsible financial system. It cannot play the role of saying, this is about the market, we want to minimize regulation as much as possible, we're just going to leave the market to get on with it. This will not work. So the playing field has to be decent, it has to be level with respect to those institutions that are already trying to create change. Although there is much that ordinary people can do and ordinary institutions can do, it really is down to government to create the landscape within which that's possible.
If you look at countries that are currently doing quite well, measured by economic growth, so notably America and Germany, then and you ask why, there's a variety of reasons. And one of the strong reasons is that they have far more local banks.
We are missing a whole layer of banking in this country. We don't have the small local community bank, the Sparkassen in Germany, the community development banks in the States, that are really being the backbone for disadvantaged communities, a mechanism for people who are the least well off to become financially included. for small businesses to actually find a source from which they can start up.
We wouldn't have to change the existing banks. You just newly create banks which are not for profit and are in local areas, communities, municipalities, owned by a foundation, endowed perhaps by the communities, and that have a restriction on their area of activity to the local area.
One of the real questions is, could you take something like RBS and use that structure to begin to create that kind of network? Because if we wait for that network to grow organically, it's going to take a long period of time. Now, I don't think it's a given as a solution, but I think it's a mechanism that has to be looked at.
Well, if we don't do this, then increasingly money for investment will remain either in government hands or in the hands of corporations. And those corporations have tremendous internal conflicts of interest.
One of the reasons that finance turned to making money out of money instead of financing industry and enterprise is that industry and enterprise aren't as profitable as they once were. And this problem has got to be solved somehow.
Now, the only way to solve that problem is for there to be an authority, a regulatory authority, that is responsible for looking at the economy as a whole. That can't be the banks, so it has to be the central bank or the government as a regulator.
Government is able to take the long view, and government is also able to see that profitability isn't everything, that things have social utility, which don't give rise immediately to profit.
Something that can be done immediately without any disruption or having to change anything. The Bank of England, as bank regulator, issues the regulation that banks are only allowed to lend and therefore create credit for transactions that actually contribute to GDP. Now, this doesn't mean, by the way, that we're banning speculation. Speculators can still speculate, but they just don't have access to what is a public privilege, namely newly created money supply. That should be for the benefit of the economy, and the simplest way to do this is to say this should be for transactions that contribute to national income, to GDP.
And so really there's an incredibly strong case for there being guidance to banks about which sectors they can provide credit to. We've had those controls in the UK up until relatively recent history. They exist in many economies around the world. It's a basic building block of a stable, safe and useful banking system.
The point about it is that you have to know what your priorities are. That is to say, you have to have a view on the kind of economy we want.
My definition of a sustainable finance system would be a finance system that supports the investment needed to create a sustainable economy, a green economy. There is no economy, there is no society without ecological assets. So if we cannot invest in protecting and maintaining ecological assets, we just don't have a finance system.
Fixing the financial system isn't just about making sure it doesn't crash again, although that's important. It's making sure that it actually is fit to deliver an economy that is fit for the 21st century, that can meet the needs of people and planet over the long term.
Taking climate change seriously and providing green infrastructure for a complete reorganization of energy supply and the like is a turn that the economy ought to take, but it's not a turn which the private sector sees as profitable. And the public sector is unwilling to interfere in major ways in things they consider the private sector ought to deal with. It's a terrible bind. Something has to give.
What we need in finance is long-term, committed, patient finance. Now, in some countries, this has been in the form of a state investment bank.
So national development banks do one of two things generally. They support small business lending that otherwise wouldn't take place, and that the lack of that lending damages the economy overall. The second thing they do is they support investment in infrastructure. And some infrastructure, particularly when we come to transforming the economy to a low-carbon economy, is a long time frame. It's a long investment horizon. It needs patient, low-cost capital.
So I definitely believe that we should, explore the possibility of a state investment bank, but also to be very courageous with it. It shouldn't just be there for counter-cyclical lending. It should be providing finance to the areas which the UK really wants to develop, and the particular areas where we know that private finance is not going to be coming in.
We have systematically created a system that is almost hell-bent on its own destruction. And we need to start from scratch. We need to say, which is the investment that we want to incentivize? How do we do that? What kinds of financial institutions do we need? How do we regulate them? What kind of lending do we need? Peer-to-peer lending, community banking, community bonds? Do we need banks actually to have an explicit mandate to positively screen their investments so that we're investing for good? And I would say we need to do all of those things. They're design features of a new, a different, a better, a more sustainable financial system.
We need to understand that we don't want to judge the efficiency of markets by how easy it is to trade. We want to understand the efficiency of markets by what markets are actually providing for the end users of markets, companies and savers.
It's right that civil society is turning its eyes on the finance system and really beginning to figure out in a coordinated, intelligent, strategic way, how can we hold the system better to account and make it serve our interests. And when we get that right, huge benefit will flow from it.
There's the huge opportunity for policymakers to come and start engaging with us, because the answers to these lie often in how do we recalibrate policy so that we get rid of the problems that we've identified and enable the way forward, because it's not just about stopping the bad, it's about enabling the good.
Reform is not a nice to have, it's a have to have.
It's a case of never waste a good crisis, isn't it? We've already wasted 6 years of it. Let's get going.
I think in the 21st century, it's about time that we identify the problems, address them, and have a banking system, a financial system fit for the 21st century.
It's a great time to transform the financial system now because it's in a state where it's not working very well. So it's always easier to make change when things are in a state of flux anyway.
The next 100 years of money is going to be about how quickly we can democratize finance and how quickly we can take power back as individuals and start to do something about all the problems that we see around us.
We know what we need to do. We have the technology. We just got to get on and do it.